All right. We are live like I try to do every Monday, 6 p.m. Pacific Standard Time, answering all your mortgage-related questions, talking about the real estate market, talking about mortgage rates, mortgage regulation, things that are happening in the market. I enjoy this thoroughly, and I think that, as we've seen over the last few weeks and months, more and more people are joining, more and more questions are being asked and answered. People are finding value from not only the questions that they have, but also the answers that are being provided collectively from me and everybody in the chat on all your questions real estate related. So looking forward to jumping into it. I saw a question that was presented even before we started from Dorothy Jones. Dorothy, I'm in Sacramento, California, but my advice is good all over. You're asking about a NOD being filed. For anybody who's curious, an NOD, a notice of default, was filed on the property, more than likely because of overdue payments. And I think that for whatever reason, hadn't entered into forbearance, which I wish you would have been in a lot better spot now. But however many late payments you have, however late it was, it's obviously going to be a big drag on your credit score. That's going to be problem number one. But like you said, you've been making on-time payments for 5 months. Once you get to the 12-month period of making on-time payments, that's when I would explore getting a loan done. And here's the thing is that nobody can give you a definite answer. Hey, 12 on-time payments, we can get a loan done for you. What's going to happen is you're going to apply for a mortgage. Lender's going to take all your information, submit that into the automated system. And the automated system, based on where your credit's at 7 months from now, based on all the other factors, is going to basically kick out an approve eligible or an approve ineligible. And if it says approve ineligible, it's more than likely going to be the 30, 60, 90-day lates that were, before this 5-month period, like you said, you've been paying when you were in default and you were behind on payments. And so that's my best advice to you. After you've reached 12 payments made, talk to a local lender, have them look up or put together a file for you and just submit it to see where you're at. Because I can't tell you for sure it's going to be approved, but I'm going to tell you for sure without 12 months of payments being made, it's likely to be near impossible for you to get a loan done. So whatever the circumstances surrounding that, sorry, glad you're able to stay in the home. Glad you're back to making payments. Wish you the best and reach back out when you're 12 months. Let me know if you're in California. Happy to help. If you're outside of California, that's where I send folks to my friends over at UMortgage. Just fill out the link at greatmortgagebroker.com. It's 6 simple questions. And from what I've heard, the feedback I've got, you should have somebody reaching out to you within 24 hours. I will tell you, they had a little bit of an issue with whatever it was plugging into their CRM and basically assigning it to somebody to call back, this nationwide broker that my buddy runs. And they fixed that. So if you're not being contacted within 24 hours, let me know. And I've jumped in on some of these, even though I'm not necessarily involved with the mortgage part of it, just to say, hey, if I'm sending people your way to get taken care of and they like and trust me, you better darn well take care of them and not mess up my reputation. So that's that. We'll make sure you get taken care of. Oh, you're in California too. All right, cool, Dorothy. Well, 7 months from now, September, October, November, December, January, February, March. Call me in March. Let's take a look in March 2022. Another one of your questions was whether rates will stay low for 2 years or more. Your guess is as good as mine. Some of the latest things that are being discussed with the Fed and whether they're going to continue to buy mortgage-backed securities, whether they're going to start, pulling back on how much of those mortgage-backed securities they're buying, which in layman's terms mean rates are going to go up. A lot of that talk has kind of steered towards rates going up sooner rather than later. And the funny part is I had finally bought into all these people that are like, hey, listen, they're stuck. The Fed's stuck. They can't raise rates. They've gave us this steroid so long. that the economy is dependent on it. They can't do anything with rates. They're going to stay low for the foreseeable future. I finally gave in. Like a week or so ago, where I was like, all right, maybe rates are just going to stay low for years. What do I know? Even though I really thought that rates would tick up towards the end of 21 and into the beginning of 2022. Now, all of a sudden, from the middle of last week, August 4th, 5th, and 6th, and then again today on the 9th, worsening. And it's a combination of some Fed members starting to say, hey, listen, we're going to raise rates sooner rather than later. I know we said 2024. I know we said 2023. Now we're thinking Q1 of 2022. And just the discussions around raising the Fed funds rate that early or tapering the purchase of mortgage-backed securities, because the Fed, I can't remember what the latest number I saw was, but by them buying mortgage-backed securities, tons of them, $100 billion a month worth, they're buying like 40% of the market. They stopped doing that. My easiest way to explain it is they like back away from being the buyer of $100 billion a month in mortgage-backed securities. They need the rate has to go up to find new buyers. The buyers aren't buying as much as they need to buy at that price, right? The only one that's buying, I shouldn't say the only one, but the biggest buyer is the government, right? And the government steps away and says, hey, we're not going to buy as much. The way to continue to sell as much as you're selling is to raise the yield, raise the rate. So we'll see. I don't know. I'm just some guy on YouTube. So what do I know? All right. Nicole Jansen. Self-employed, do I need to show all 1099s to support income claimed on the tax returns? A lot of my clients don't 1099 me, pay me less than $600 a year. I get paid via check, cash, or Square. I report everything. Well, what a lender's looking at for you, if you're self-employed and you're filing probably a Schedule C, is whatever you report, top line, you made $88,000. You got write-off. Line 31 or 32, whatever line it is, where it's your net income after all your write-offs, $36,000 for the year. That's the number that the lender's looking at. So they're going to say you made $36,000 bottom line, $3,000 a month. If they look at 2019, 2020, and year-to-date 2021, what's that average going to be? Is it $36,000 in 19 and $48,000 in 20, and then year to date in 21, it's $24,000. Take those 31 months, divide by 31, and that's what the underwriters are going to give you as a self-employed borrower. It's tougher, and you got to be trending up. You can't have a $36,000 19, a $14,000 20, and then have a great 2021 year to date and expect the underwriter to feel good about that. And more than feel good, right? The underwriter is going to say, listen, last year you made $14,000. And so one, your income from 19 to 20 was trending down. Two, we can't necessarily rely on this profit and loss that you supplied us in 21 and feel like your business is recovered, even though it might be. In all actuality, you might have had a slowdown during COVID, businesses ramp back up. A hairdresser is a perfect example where, they were shut down in California. No fault of their own. Their income was down in 2020. And so, anyhow, that's a long-winded way of saying, I'm sorry that self-employed guidelines for lending is the way it is, but it is what it is. And so you got to have a healthy, thriving business that's been healthy and thriving for at least a couple of years is the general rule for self-employed borrowers. All right, Sam, just signed up for a new build. Build time is 10 months. Do you see rates staying relatively close to what they're at now? This is the $1 million question. I could just do 2 hours of live every single Monday, talk about what we think is going to happen with rates. I wonder if I got this chart. Let me see. Longer time frame. Oh, this is cool. I can go back a year. Wow. I was looking at rates over the past year, 2 years. I mean, what's the worst they've gotten in the last 2 years? Mid threes? I don't see them changing a ton. I see them going up. If I were to guess, and you told me like right now, par interest rate is 2.75 on your scenario, where do I think you're going to be 9 months from now? My guess would be 3.25, which in the whole scheme of things is an amazing interest rate. Let me show you this chart. And I'm not going to be the guy that shows you friggin' 900 years of mortgage history and be like, well, rates are historically great because in 1981 they were 18%. Nobody cares about 1981. 1980 is the year where all the amazing folks were born. This is 2 years, and granted, this isn't rates. This is basically the mortgage-backed securities chart, but it's still, I could tell you what these numbers mean rate-wise, and at the very tippy top, boom, 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 all these numbers, like this is August of last year up in here. And then like November and December, this is like the lowest rates of all time. And we're here, we're probably within a quarter. But like over the last 2 years, besides this, wow. What was going on here? Was it that bad? I guess rates tanked before they got a lot better. That's crazy. This is like March of 2020. I thought this thing was going back 2 years. This is going to the beginning of 2020. So this chart's the beginning of 2020. And way down here, maybe we're at 4%. And then we get better, better, better. Let's call 2.5 the lowest of all time. Let's call 2.75 here. Like, I just don't see it making a drastic, shift up. I think the worst you're going to see, Sam, is 3.25. I got kind of lost there, so forgive me for that, but relatively close. I would say you're safe. What's up, Joey? Good to see you, my man. I'm happy to host. Happy to be here for another Monday. You don't see me anymore. That's when you start to worry. Because when I basically committed to myself that for at least 6 months, I'm going to do it every single Monday. We'll see how I go. Hopefully it doesn't conflict with any, kids baseball practice or anything like that. I'll still do it. I'll just change the date if I gotta change it for coaching baseball or something that's high priority in my life. All right, Zeta. I appreciate you. A super fan. I'll call you super fan. I see your comments everywhere. I appreciate your support. In your area, seeing a little bit more inventory, but still high priced. And this is the thing too, is like, we're not necessarily going to see a rapid decrease in prices just because we got a few more houses on the market, because what's happening too, I've talked to sellers personally that are like, man, what happened? I thought this was a seller's market. I listed my house and I didn't sell it. They're not in a position where they're just going to put it on a 10 or 15 or 20% discount. If they can't get what they listed it at or within 5% of that, they're just not going to sell it. They listed it to sell on the presumption that, wow, I could sell my house for $500,000 right now. And they're sure as heck not going to sell it for $450,000. I mean, that's a 10% discount. And so that's where, buyers need to realize more stuff's going to come on the market. It might sit a little bit longer, but I know there was some sellers that were selling just because they're like, wow, if I can get 500, I'll sell and I'll take that and I'll buy something new, or I'll sell and I'll do this, right? Or maybe even investors. I've thought about selling an investment property too, if the right offer came along, if it was enough, right? But these homes are not going to go down in price 10, 15, 20% just because buyers want it to, because there's still enough demand to where they can demand pretty close to what folks were getting in March and April. I think March and April were really like the golden months for sellers, at least in my area. Stuff was flying off the shelf and you could list it at anything and they'd offer you 10% above that. But now there's still a lot of demand and people are still willing to pay list price, reasonable price, right? But they're not paying 10, 15% over list price and going bonkers against 15 other offers. So you're going to see prices stabilize and flatten. You're not going to see them drop. And that's my prediction for this fall, Zeta, since you asked for it. Every market is different. And there's sub markets and whatnot where, Phoenix, Arizona might be hotter than, Riverside, California, and Boise, Idaho, because they were on fire, might cool down and even drop 5%. Every market's going to be different, but I think in general, the feel is going to be flat. If you're to ask me, like for my prediction, right, is, we've seen crazy home price appreciation. We're not going to see depreciation, but we're also not going to see, it continue to trend up like it has. If it, remained fairly flat in 2022, saw 3% price appreciation, I wouldn't be surprised. It'd be healthy for the market, to be honest, too. Got to celebrate small financial wins. I work for a university in Oklahoma and am about 3 years into the public service loan forgiveness program. Got to give a shout out to the Biden admin for continuing student loan forbearance. All right. So you don't have to pay on your student loans, and that's the win. All right, Joey. All right. Do you, boo? I guess that's that's a win. I thought there was something, being forgiven or something, but all good, man. Kevin Hawthorne, what's up, brother? Thanks for joining. Good to see you here. Nicholas, thanks for joining us. Our new home build is looking to be completed in 60 to 90 days. I'm nervous with rates ticking up for the last few days. Will rates be similar to now in that time frame or continue to rise? Well, if I had that crystal ball, I would certainly love to help you out. But unfortunately, why does this look different now? Like I was saying right at the onset, like August 4th, 5th, and 6th, Wednesday, Thursday, Friday, worsening, today, worsening. And it hasn't been a humongous shift, right? Like rate wise, it's probably up an eighth from where it was last Wednesday. But if you're 60 to 90 days out, I think I'm back to where I was last 2 months ago, where I was telling the new build folks that if this was me, and that's the only advice I can give, right? I'm just some dude on YouTube, happens to be a mortgage broker, happens to follow a bunch of smart people in regards to real estate and mortgage. But if I was you, Nick, I would look at the 60-day lock when you're within 60 days. And you look at it and go, you know what? 2.94 sounds like a good rate to me. Let's lock it. You're just going to sleep better, I think. Folks who are just like, well, maybe it's going to go lower. Maybe I'll wait for that. Then it slides and you pay 3.1, right? Or it slides worst case, and you're 3.25 or 3.375 or something. I personally think that it's going to trend upwards. And I think that the news that we've got over the last week, not much is going to change with that news. It's basically a function of the Fed back talking what they talked about with inflation, like, oh shit, maybe inflation's here. Maybe it's not transitory. Maybe we do have a little bit of inflation. And then the latest I'm hearing about countries like Mexico who are, essentially raising rates and, other countries in anticipation of future inflation, raising interest rates. The US is just going to have the same inflationary pressures, and the Fed has already talked about raising the Fed funds rate sooner rather than later. So my long-winded way of saying, if you like it, you lock it. And that's what I would do if I was you. I'd look for a completion date. And if they tell you, we're going to be done November 5, I would be looking at 60-day locks come early September and lock it in. Final answer. All right. Uruguay. Thank you for joining us. Good to have you here. I submitted an offer on a home that needs repairs. I was approved for a renovation loan. Can I offer more money on the home and less money for repairs as long as I stay within my pre-approval amount? It's if I understand correctly your question, you're pre-approved for $350,000, and you're saying instead of offering them $300 and then $50,000 in repairs, maybe I offer them $310 and I get $40,000 in repairs, and then I'm all in $350. I'd speak to your lender because those renovation loans, they have limits for the repair amount, specifically the FHA 203K. If you keep it under $30,000, it's considered an FHA 203K streamline. If you spend more than $30,000 or there's structural repairs or something like that, then it's considered like the full-fledged 203K. So it's going to change the loan program. I think the answer to your question is yes, you can do that as long as the all-in amount is under your pre-approval amount, but check with your lender to make sure that you're not changing the loan program by raising or lowering how much you're doing in repairs. Well, yeah, you don't want to do a 30-day lock. That's going to expire if they're not going to be done for 60 or 90 days. So they've got, every lender has a 60-day lock. And above 60 days is where it gets really expensive. So I probably wouldn't recommend like a 90-day lock or some of these longer ones, but I'm sure they've got a 60-day lock, and they should be looking out for your best interest and saying, hey, we can lock it early September. Just be careful too, because builders, even through no fault of their own, are missing deadlines. And so if you get in a 60-day lock and things not going to be done until December, and that thing's expiring early November, could put you in a bind. And that's definitely not something you want to get into, is thousands of dollars in extension fees, because builders, I don't want to bad talk them, but they're not gonna help you out, and maybe it's with good reason. Maybe they got their own costs, they're out of control, and their own delay issues that they're dealing with. John Doe, do lenders look at childcare expenses? They don't look at childcare expenses like you got $900 a month in childcare. They'll look at, if you're divorced and you pay alimony or something like that is something that they're going to look at because it's court ordered. But if it's not court ordered, it doesn't show up in your credit report. Lender doesn't know if you pay $1,200 a month in childcare or you pay $400. That's not going to show up in the calculations for how much you qualify for, DTI wise, which I think was your question. Arnold, thanks for joining us. Thanks for being back. I know I recognize the name from some prior lives, and I love it when you guys keep coming back. It, to me, says that you got at least some sort of value from it because you're back again. So thanks for joining. Bring a friend next time. You were pre-approved 2 months ago, and now your income increases by $700 a month with your second job working more hours. Can I request a new pre-approval? You can certainly request a new pre-approval. I would warn you against, lenders aren't always going to be able to use income from a second job. The general rule is you got to have both jobs for 2 years. And so it sounds like it's maybe a part-time job because it's now more hours. So hopefully you've had that one for at least 2 years along with the primary job. And if so, then if you're earning more per now, realize they're not going to give you $700 more in income starting right now, but it is going to pull up your average. If it's a part-time job where you used to be making $1,300 a month and now you're making $2,000 a month, you're like, yeah, I'm making $700 more per month. Well, you look back at a 2-year average and you take 19 and 20 and then add the year to date for 21, maybe the last 2 months of that $700 extra pulls it up from $1,300 a month average to $1,375. That's how they're looking at it versus like, now it's $2,000 a month. Where you do get to use a new income effective immediately is when it's salary. If you've got a job that pays you $5,500 a month and you've been doing a great job and the boss says, congratulations, you're going to be a supervisor 1 now and you're going to make $6,500 a month starting August 1st. We can use that right away as long as it's a set amount and it's salary, right? Where we can't use it right away is if it's hourly or it's variable. That's where the lender always has to use an average. When your income changes, we use an average. When it's a salary, it stays the same. We can use whatever the new amount is. That's the general rule. Nicole Janssens, thanks for joining us. If you are renting out your departing property and purchasing a second property, how many months of reserves do you need on each? Sorry, guys, I'm having a hard time reading. My brain is shutting down. If you move out of your current residence, it's funny. I started to answer a different question because the more common question is like, can I use the departing rental income? And I'll answer that even though you didn't ask it, because that's a really common question. You're leaving that residence and it rents for $2,000 a month. We can use 75% of that, $1,500 as rental income right away with a lease agreement. But your question was, how many reserves do you need? How many months of reserves do you need on each? More often than not, when you're buying your new primary, a lender is going to ask for between 3 and 6 months of reserves on that, which is now a rental property. And they're going to ask for 3 to 6 months reserves on all rental properties. So if you own others, you'll need that. But let's just say that this is the only rental property you own, and the PITI, principal, interest, tax, and insurance, is $1,500 a month. 3 months would be $4,500. 6 months would be $9,000. If you don't know what reserves are, it's basically a lender saying, hey, we want to see an account where you've got some money in case things go south. And so it doesn't have to be money that you're bringing to the closing table. It doesn't have to be necessarily an account that you're going to withdraw from. You can have a retirement account, an IRA, a stock investment account, and you show us like, oh yeah, look at my Fidelity account. There's 24,000 in there. Okay, cool. We'll use that as reserve funds to cover this reserve fund requirement. And the lender's going to do this most always when you own investment properties, between 3 and 6 months, depending on the lender, of reserves, just proof that you've got money in the bank should things go sideways. Jennifer Sabino, thanks for joining. Appreciate having you here. Do I think FHA mortgage forbearance will be extended? My honest opinion is that if this Delta variant of COVID does not become too big of an issue, then it won't be. And we'll try to get, a lot of people have had forbearance for like 18 months. And so if people are able to get back to work and things are opened up and all of that, it probably will not, and it will come to an end. But if for whatever reason, God forbid, there's more lockdowns or, this Delta variant proves to be something that's a big issue in the country, then maybe the FHA mortgage forbearance will be extended. Oh, I see what you're saying. These months of forbearance count towards your 10 years of payments. Oh, I see it. All right, Joey. Now I'm picking up what you're laying down. Now you're like, not only am I not having to pay every month on these student loans, but it's counting towards my 10 years of payments in public service, where you basically only have to pay 7 years now and you're going to be free and clear. Well, good for you. Use that money, put that money to good use, bro. Can you please explain this 25% off the payments if you're on forbearance with an FHA loan? I'm not sure what that's pertaining to. 25% off the payments. What kind of loan were you trying to get, Michelle? Was this like a non-QM loan or something? I mean, in the context of how low rates have been for the last 3 or 4 years, I mean, even more than that, like, yeah, 5% is high. I mean, when I talk to people about some of these other products that are out there that aren't, conventional or government loans, that do carry rates like a 5%, then I tell them, rates are high. He said, based on what? I mean, partly true, right? When people are like, oh my gosh, 3.2, that seems kind of high. I'm like, well, it's not really high. You got a 664 credit score. That's part of the reason. But yeah, I guess it's how you look at it. But I mean, 5% is high in the context of how low rates are recently. All right. Lender sold my Fannie Mae backed mortgage to a new servicer, just got out of forbearance and started flex loan mod trial. I mean, I would imagine they have to. So it sounds like you got a modification proposal from your lender, and they said make these 3 trial payments. I've seen that recently, and it's similar to what it was 12 or 15 years ago when modifications were happening. And so you've got a 3-month period of making these modification, like trial payments, and then you enter into full-fledged modification. I can't imagine a new servicer would not have to honor what the past servicer had offered you. So give us an update once you find out. Hey, Matt, I sold my homework, was in forbearance, and paid off the loan. My lender is now saying I'm only eligible for conventional loan, but not FHA or USDA. Is that accurate? I sold my home while I was in forbearance. I sold my homework. Well, here's the thing, Chris. Some lenders are requiring you to make 3 payments after you exit forbearance. Other lenders, as soon as you're out of forbearance, you're good to go. So my guess is you just need to talk to another lender. You need to talk to another lender that can look at it and go, oh, you're in forbearance, but you sold that house. That loan is paid off in full. Okay, cool. You're ready to roll. And I almost guarantee you that there's lenders out there, as a broker, I get to look at 60 different lenders. And there's some lenders that will say, we don't want this loan from somebody who just exited forbearance until they've made 3 consecutive payments. And that's their prerogative. They can make whatever rules they want. But if I have someone that's right out of forbearance, I can take that loan down the street to the other lender that says, hey, we're open for business. We want the loan. And so that's my best advice to you. Talk to another lender. All right, Michelle. He said go conventional. And even at 680, I mean, is this an investment loan or is this investment property, 20% down, 680 credit? Maybe you're up there in the 4s, but no way you're at 5% on our owner occupied house. Give us some more deets on that one. All right, Johnny. New build construction, builder wants me to pre-qual their preferred lender. Super common. Almost all of them do that. To be put on a VIP list, even if I don't use their lender. Lots open October 1st. Can I pre-qual now to be ahead of the list? Yeah, I mean, you can go ahead and get pre-qualled with their preferred lender. Almost all builders want you to do it. And I don't even really blame them. They want to make sure that you're fully pre-approved, ready to purchase and able to. And let's say that me or you owned the builder, right? Let's say that I was the builder and I've got in-demand houses that I can sell for a premium, and therefore I get to make some of the rules. My rules would be, listen, you've got to get pre-approved with my people. If you don't use them, that's fine. I'll offer you an incentive to use them because I'd rather be able to like know what's going on with the loan and talk to them. You can use whoever you want. I just don't want someone holding a home, you know, being in contract and having this lot like reserved for 4 months and then finding out you can't buy the house because it's really common for somebody to call up Rocket Mortgage or somebody to call up some of these other bunk online lenders, and they take a half-ass application, get a couple of docs and go, oh yeah, you're good. You can buy a 600 or 5% down. And then a month from now or 6 weeks from now, you're in contract. They go, oh, we didn't look at that or that. Yeah, you don't qualify. We can't get a loan done for you. And, you know, surprisingly, these lenders still do business. They still have a decent enough reputation where people are sending them business. But, you know, that stuff happens more often than most people would like to admit. And so they just want to know that you're qualified. But yeah, do that. Get qualified with their preferred lender and say, cool, I'll play your game. And then talk to a local mortgage broker, look at both of them. I've done 100 of these side-by-side analyses where I'd say, you know what? Go with the builder's lender. They're offering you a $5,000 incentive. We're $3,000 better, but with that incentive, they're beating us by $2,000. Or in some cases, it's like, listen, they're offering you a $2,500 incentive, but I can get the loan done for $5,500 less. So I'm $3,000 better. You should use us. And you should tell them, listen, my friggin' loan, my finances, I can use whoever I want. I'm going to use my buddy, Matt, the mortgage guy. It's really been probably 50-50 over the last couple of years as builders incentives go down, because they feel like they don't have to give that to get people in the door, get people to close. Brokers have been able to beat out and earn some of that business. Whereas before, if I had a builder offering a $10,000 or $7,500 incentive for using their in-house lender, I'd tell my friends to use the in-house lender, right? Because even if I'm $5,000 better, that incentive is squeaking them out the win, right? So, yeah, just talk to someone who's going to shoot straight with you, like we would if you were in California. I have an investment property loan for a newer investment property with a 4.75. Is it a good time to look into a potential refinance? It depends on how much you owe, Jessica. If you owe $400,000 and you got good credit and it's 70% loan to value, I'd say we'd probably get you a 3.5, and that's well worth it. If you owe 110,000 and your credit's 716, I'd say leave it alone. You're not going to improve the terms that much with that score. And that small of a loan amount too, right? Because a full percentage point on 400,000 is going to save you $4,000 a year in interest, roughly. And, you know, that same 1% spread, if you only owe 110,000, is $1,100 a year. It's going to take a lot longer to recoup whatever costs there are involved with the mortgage, which alert, loans cost money. If they don't cost you on the net sheet where it says underwriting fee, appraisal, title fees, if those things don't show up, or they're like, oh, no, we've got a $3,300 credit, covers all those costs. You know where that $3,300 credit came from? Higher interest rate. So it cost you somewhere, somehow. There's not magic mortgage fairies that come over and sprinkle dust and create no cost loans. As much as everybody who works for big mortgage companies and creates advertisements for big mortgage companies wants you to believe that there's no cost loans, that's just not how it works. They plug it in somewhere else. They get you somewhere else. If they don't get you in the front, they get you in the back. This is a good one. I had a buddy hit me up. Anybody who doesn't know what STR is, short-term rentals, like Airbnb. And if you have it on your tax return, just like a general rule for lending is like show it on your taxes for 2 years and we can use it as a lender. If it's less than that, if you've been Airbnb in your place since February and it hasn't shown up on any tax returns yet, no can do. Another thing that you want to take into consideration, a buddy of mine who's a great dude who did a loan with us years ago has a place that he occupies, and then he does short-term rentals when he's not teaching, leaving during the summer, leaving during Christmas break, leaving during holidays and whatnot, and does the short-term rentals. He's going to be Airbnb in it full time once he moves out of it. So he's like, listen, I Airbnb this thing for 90 days a year. I make 25 grand. When I move out, it's going to generate 75,000 because I'm going to be able to do it full time. Can't use that income. Just the lenders aren't creative enough to say, oh, that makes sense. Like you made this, we can project that. Like projections, no can do. 2 years on your tax returns, final answers. Beatles. All right. They told me to wait until sales open, but read builder's lender is terribly slow on pre-qual. Yeah. I mean, you could do it now, and that's what I'd probably do. Here's a piece of advice for you though, Johnny, is, you don't want to wait on the builder's lender. You want to get pre-approved. Any lender, here's my advice to you. To do it in good faith, right? You're not just doing it just like, hey, I want to get pre-approved with you. I'm not going to use you. I'm going to use this lender, but just do a bunch of work on your end and thanks. I would do it with the intention of, hey, I'm going to get pre-approved with you. And when the time comes, I'm also going to get pre-approved with the builder's lender because they're going to require it. Then I'm going to compare. And whoever I like the most, trust the most, can get me the best deal is who I'm going to move forward with. Because then you're not just like spinning somebody's wheels just for the sake of it, which I think you'll find if you talk to a local mortgage broker, they're going to be priced very competitively. And depending on how much incentive the builder is willing to give for using their lender, the broker is going to either be better or worse. If they're giving a humongous incentive, like $7,500, maybe it's better to use the builder's lender. If they're only offering $2,500 or less, then the broker can probably beat them out on price. But last piece of advice, you get pre-approved now, and you get pricing and scenarios based on August 10th. Then you talk to the builder's lender and they give you something on August 19th. Don't compare the 10th to the 19th. Get loan estimates on the same day. So you can compare that same day pricing, because pricing fluctuates every single day. I might be better or worse than somebody who created an estimate for you on July 31st, but a lot has changed since July 31st, right? We've seen some ups and some downs and some greens and some reds, just like this. See, this is where's July 31st? See, like in here is July 31st, and then August 3rd, a little worse. August 4th, worse. 5th, worse. 6th, worse. 9th, worse. So we're definitely looking at a downtrend in rates. Probably, I don't even think it's a quarter since the middle of last week. It's probably closer to an eighth in price. We still good. All right, VSJ79. I thought you would never ask. Are there jumbo loans available for 10% down? No MI. Well, you're in luck. You are in luck. I actually made a few videos on this because it was March of 2021 when my favorite lender, United Wholesale Mortgage, came out with their 10% down jumbo. I'm going to price it for you so I can give you some real accurate 10% down jumbo. I'm just pricing it on my other screen because that's how I like to do it, rather than like a guesstimate or dancing around the question. I'll give you the exact pricing. So They came out with this product, 10% down jumbo. It follows conforming guidelines. So there's not like all these extra things that need to be done, 2 appraisals and 12 months of reserves, and all the stuff that really is a pain in the backside for conventional loans gets thrown out of the window with this awesome program. As you can imagine, or as you should imagine, when you do 10% down and don't pay mortgage insurance, the rate's going to be slightly higher because you're basically baking in mortgage insurance. 1,277,920. 1,277,920. That's my purchase price. Because then at 90% gets me that 1.15 loan amount. So don't be shocked when I come back to you with mid threes rate, because remember, you're not paying mortgage insurance. So if you bought something high balance and you had a 2.8, but then you had, $390 in mortgage insurance, that 2.8 wouldn't be as good as this sweet 3.6, 3.5, depending on credit score. That specific loan amount, you're probably 3.6. The bigger the loan amount, the smaller the rate. But yeah, 3.6 with no mortgage insurance. And so if you plug that in and you're good with the 3.6 rate under 43 DTI, you should be good. Let me know what state you're in. I can connect you with somebody who can help you out. But that's definitely out there. 5% down, owner occupied. Michelle, this is who is this person you're talking to? Is this like Churchill Mortgage or something? 680 credit score, you said, right? I don't know where you're at, but I'm gonna put 300,000 for the loan amount. That's another thing I didn't ask, but maybe if the loan amount is like 90,000, the rate could be really high. But 5% down, owner occupied, 680 credit score. You got to have, the rate's like about 3%, 3.125. It's certainly not 5%. Who are you talking to? All right. For anybody who missed it, Michelle had a lender tell her 5% rate. That's some crazy talk. Hey, Jennifer, I think I saw something in forbearance on an FHA loan. They said they're offering 25% off your monthly payments if I refi. I don't know. Get me something in writing and send it to me, matt@mattthemortgageguy.com. I would love to review it for you. I don't know if you're talking about, like, there was some verbiage in one of those refinance programs where, I don't know. Why wouldn't you? Why wouldn't you just say, hey, you're going to lower my payment from $1,600 to $1,200? Let's go. I'd like to know what the catch is. In forbearance with an FHA loan, they said they're offering 25%. Send me some info, please. Matt, M-A-T-T, @mattthemortgageguy.com. I'm interested. If you're planning on refinancing, I wouldn't modify, but some of the modification options, be honest here, I'm a mortgage broker who gets paid when I refinance folks. I don't get paid by giving you modification advice. Some of the modification terms are better than a refinance. So if I was you, what I would look at was, am I better off refinancing or better off modifying? If I'm better off refinancing, then I come out of forbearance. I can slap it on the back or do whatever I need to do to take it out of forbearance and then refinance. But I wouldn't even bother with the loan mod, because the loan mod is, I think that a lot of people have said it's not going to hurt your credit. Those 3 trial payments, like, it's not going to show up delinquent or whatever, but I wouldn't risk that if my plan was to refinance. If your servicer's willing to say, hey, I'll put you in a 30-year loan or a 40-year loan, I'll lower your interest rate and I'll modify you without any costs, like, by all means, do that. But if you're coming out of forbearance, you got a 3.75, you can go get sub 3% with a refinance, then just exit forbearance and refinance. Don't mess around with the loan modification. There's no benefit to it. That is my final answer. All right, Jessica. Now I got to look up to what we were talking about. Oh, investment property. 4.75. All right, so you got 130K left on the loan and it's worth 210. I probably wouldn't mess with it. I mean, you could rate and term refi, investment property, 130. I'm gonna give you the pricing so we can talk about it and see in real time. This is a rate and term refinance on an investment property. I don't know if I caught your credit score. We'll assume good. And you're under 60% LTV. Oh, maybe not. 210. Maybe you're above it. Yeah. Yeah, still. Just above 60%.
Sorry, I missed what you said.
My Apple Watch said I was talking to it. Not yet. I'm talking to you. All right, let's see what we got here. Rate and term refi and investment property. Yeah, I mean, you could without paying any points get a 3.5% rate, 3.599. But here's the thing, like that's 590 principal and interest. So I wonder what your current payment is. Probably 475. I would guess it's saving you $100 a month. And so there's a lender's flat fee, $1,200 in title fees, an appraisal and a rent survey is probably needed. Let's say all in it's $3,000 in costs. That gets rolled into the loan. Takes you 30 months to break even. If you're planning on holding this property for a long time, then maybe you do it. It's just not a huge benefit on that small of a loan amount, right? If that $100 a month is meaningful and helps you out cash flow wise, and maybe I don't know. It's one of those on the fence. I'd present that option if you were coming to me in California, and I'd say you're going to save $100 a month. It cost you $3,000. Here's how it works out. You don't pay that $3,000 out of pocket. Rolls into the loan. Here's what it looks like. You're saving $104 a month. Would you like to proceed? It's not a green light. It's not a red light. It's a yellow, and you get to decide whether you hit the gas or hit the brakes. And I just present options. That's how I operate my business. So that's the advice I would give you. Unbiased, not knowing whether you're in California, whether I can even help you, and just trying to steer you in the right direction if it was me. VQuez, hello. Thanks for coming back. All right, we got Striker Bravo all the way from Florida. It's 10 o'clock in Florida. Do you feel buying a primary residence in a mild or moderate flood area risky? To my understanding, flood maps are outdated and seems you have no control with cost of insurance increases. Yeah, I mean, to be completely honest, that's something that you deal with way more than I do. We've got a few flood areas in Sacramento, California, but the chances of flood are few and far between. You guys might have a lot higher risk, but maybe you're in an area where, like you said, the flood maps are outdated. I would look into that before looking to buy an area, because that's a mistake folks make, right? Is they're like, oh, I want to buy in this area because I can buy a nice house for only $180,000. In this other area, similar houses cost $250,000. Well, if the 180 also comes with a $4,000 a year, homeowners insurance, like that's how some areas in Northern California are. It's high fire, and it's not flood, but it's similar. Where if I've got to pay $6,000 a year for my fire insurance, then it's not such a sweet deal because I'm paying $400,000 versus $500,000. I pay $500,000 and the fire insurance is $800 a year versus the $400,000 where it's $6,000 a year. It's a better deal by the more expensive house. So that's some of the math behind it, which my brain will automatically go to. Let's just do the math. Let's look at flood insurance as in the total cost per month of what this house is going to cost. And then let's compare it to another area where there's less flood insurance and how that, compares apples to apples. How many years do you need for dividends to be counted as income? You know what? Sometimes you just got to be honest. And I honestly don't know. I can't remember the last time I used dividends from a brokerage account. I've used plenty of like drawdown from assets to be used as income. So that one's easy, where it's like, as long as you've got enough for 3 years of continuance, you can use like an IRA draw or something like that. Or like an asset depletion loan where somebody's got, 5 million assets that they're drawing from monthly. But dividends, I don't know if you can use dividends. All right. Today is 8/9. Dividend income. Can you use it? This is the best question so far because I don't know the answer. I get to learn something new. Dividend income. Can you use it? I'm trying to think of what my best guess would be. When you hold a stock and you're getting, dividends on your AT&T stock or on your, what's another one I hold that has dividends? My UWMC pays dividend. I'm trying to think of like if lenders are going to be like, yeah, you could sell that tomorrow, right? And you're not going to get those dividends anymore. So a lender's always looking at like, what did you get in the past and what can we predict that you're going to get in the future? My guess is that they don't allow you to use dividend income, but I could be wrong. So I'm going to get the answer. I'm going to get back to you. I'm even going to write down your name. I'm going to get better at this. Warren Druin. I'll address it in the next live, and I might even make a video on it because I think it's interesting. What type of investment income can you use? And that would be the video. Dividend income would be part of that. So thanks for that question. VJS, you're in Sacramento? What's up? I'm in Sacramento too. Let's do it. Let's buy you a nice, I think you're buying 1.27 or something with 10% down. I've done quite a few of those loans and they're easy peasy because they're not following jumbo guidelines. They're just following conforming guidelines. UWM's basically using that as like a portfolio loan. So it's a walk in the park. We can close them in, I closed a couple in San Diego in 17 days and 21 days. So we can write strong offers. Hit me up. Happy to help. Seth, this is a great question because right now I'm doing so many cash out refinances. I can't even count them all. And there's a couple sweet spots. If you're doing a cash out refinance, here are the official sweet spots. You get up to 60% LTV, the very best pricing, meaning house is worth 500, loan is 300,000 or below. Sweet spot, right? Next sweet spot is 75% loan to value. So $500,000 house up to 375 loan amount. Pricing is almost as good as 60%, not so good. Where it gets a little bit ugly is when you go up to 80%. So you go up to a $400,000 loan on that $500,000 house. The pricing is, as bad as it's going to get, which today isn't that bad. I guess it depends on the credit score and all that, but maybe we're talking, 2.8 on a 60% LTV. Maybe we're talking about a 3% at 75. Maybe we're talking about a 3.15 or 3.2 at 80%, depending on credit score and whatnot. But those are the sweet spots, Seth. 60 and 75%, and then 80 is just like, I want the max cash. I don't care if it's a little bit more expensive, or the case where somebody needs the max cash out. That's what they can do. But I saw a really interesting 2 articles. One article that was local to Sacramento, where it talked about people having more net worth or equity in their homes than ever before, which isn't a surprise, right? But the other one was interesting around like the average loan to value nationwide is like 40%. And then 70% of household debt is mortgage and 30% is other consumer debts. And so what I took from that was, let's use this example where your average LTV is 40%. That would mean a $500,000 loan and $200K in mortgage debt, right? And that's a 40% loan to value. Well, if you've got 70% of your debt being mortgage and 30% of your debt being consumer debt, then that same person who has $200K in mortgage debt would have roughly, what's that, like $90K in consumer debt? Out of 290, I think that's good enough. That's rough enough math for government work. Yeah, like 69% would be 200 out of 290. So let's say they had 90K in consumer debt, credit card debt, car debt, other debt. Ain't as good as that mortgage debt. But they've got all that equity in their house. Do a cash out refinance, pay off all that consumer debt. You got a $290,000 loan. You're still under 60% loan to value. So shout out to my boy who asked about where the sweet spots are. You're still in the sweet spot, right? Oh, there you go, Seth. Cash out refinance, pay off all your debt. Now 100% of your debt that you have is mortgage debt, which is the best kind of debt, the lowest rate, the most tax incentivized. Went off on a tangent, but I don't know. Maybe it was good. Great deals. Thanks for joining. If buying an unlisted property, is there anything in particular I need to look out to pertaining to financing? Any extra requirements outside the norm lenders are asking for? No. I mean, I do all kinds of stuff where landlord decides to sell to tenant, uncle sells to nephew. People work out private deals all the time. The lending is exactly the same. We're going to get an appraisal. We're going to underwrite the file. You're going to qualify or not going to qualify. The appraiser is going to call out things or not call out things that need to be fixed. And so there's literally no difference between your private deal and a deal that's listed on the MLS and has agents involved. The only warning is that, you don't have professionals involved looking over paperwork and looking out for you. So, make sure that you're covering your own behind when it comes to contingency periods and things like that. You don't want to get stuck in a deal where there's $30,000 in foundation repair, but I wrote him a $5,000 deposit that was, not contingent on anything, and he's going to try to keep it now. Our loan mod extend to 40-year interest rate is 4.25%. Yeah, I mean, I think I get what you're saying where, in the short term, you take the modification, your rate is super low, but you not probably for surely are better off going lower interest rate, shorter term, because at that 4.25% and 40 years, you're just going to have 10 years of next to nothing going towards interest, which isn't a good long-term play, having 1/5 of your mortgage payment or 1/6 of it going towards principal. You're going to be paying that thing off very slow at the beginning of that 40-year term. So yeah, I get you. And I think going back to your original question, you wanted to know whether it's okay to modify and then refinance. The honest truth is I'm not sure, because modify and then refinance. We haven't had that come up, as you can imagine, because nobody's gone into modification yet, or very few people have. And so my guess is that lenders aren't going to have any issue with it. As long as you're making your payments, you should be completely fine. I put that down as a note so I can circle back, but my gut tells me you shouldn't have any issues modifying and then refinancing. All right. All right. Dennis Park, thanks for joining. You related to Tony Park? A buddy of mine owns a restaurant here locally. I am self-employed with an S-Corp and I have W-2 income as well. What lines on my tax return 1040 and corporate tax returns do I use to calculate my income for DIY purposes? I don't know if you meant to say DIY or DTI, but either way, you can. It's like a do-it-yourself loan, right? With your S-Corp, if you're paying yourself through your S-Corp, then you can use that W-2 income in W-2 income of any kind we're going to be able to use. It's going to be your net income number and whatever your K1 is, whatever pass-through income you have. I run my business through an S-Corp. And so I've got, my K1s and whatever's hitting that, plus I pay myself a W-2. Yeah, you corrected yourself, DTI, but I knew what you meant, but DIY kind of worked in that scenario too. So yeah, I mean, with being self-employed, Dennis, you're really, whether you're anywhere near wanting to purchase, just want to get that submitted to a lender and just have them pre-approve you, just to make sure there's not any funkiness around. Sometimes self-employed folks are great business owners, great at a bunch of stuff. And, truth be told, myself probably too. I'm not looking at my taxes with a fine tooth comb. I'm letting the professionals take care of it. I'm paying them handsomely for taking care of it. And so, they might be doing stuff that's, to your benefit tax-wise. And then you're like, oh shit, I didn't realize I was showing a loss there and I'm doing this here. And your, tax advisor's like, oh yeah, it's great. I'm saving you $32,000 in taxes. But if it hurts you from a lending perspective, then you want to know that sooner rather than later. So, get it reviewed. Let me pull up. I hate to go on tangent and get lost, but I'm trying to closed loans. I wonder if they I could probably get you a calculator. I'm trying to see if they put one in here. Income. Sometimes the team will put like the calculation into nope, not there. I thought I was going to get, there it's different for S-Corp and for Schedule C and all that stuff. On the S-Corp, you basically want to see what the ordinary business income is. Basically box one of your K1. And then the W-2. You can add the W-2 to that as well. All right. Eddie Song, what's up? What's up? I'm doing well, man. Thanks for asking. Hope you're doing well. Thanks for joining. Will I be able to refinance my VA to conventional? Do I need that 20% LTV? Not necessarily, but it's probably going to, depending on the reasoning behind it. I know some people are like, I want to refinance VA to conventional because I want to be able to get my eligibility back for my next primary I buy as a VA, or for whatever reason, you can refinance. And let's say that you only have, 10% equity. I knew what you meant when you said 20% LTV. You meant 20% equity, quote unquote, 80 LTV. And you wouldn't necessarily need that, but you don't want to refinance out of a VA with no mortgage insurance into conventional at 90% paying mortgage insurance, right? So that's the answer to your question is yes, you can. Do you need it? No, but do you want it? Yes. Thanks, Jennifer. I like this mic as well. It's a Yeti mic. It's got a bunch of dings. Look at that. I put my headphones on it sometimes, and then it pulls it off the desk, and it's all dinged up. It is a good mic, though. I've dropped it several times. Will some lenders accept W-2s prepared by accountant or only the tax returns? Your W-2s you get from your employer. And so those aren't like accountant prepared. But if you're a W-2 employee, you work for Pepsi Cola and you've got a W-2 every year, that's all we need. We don't care. We don't care about the tax returns. If you don't own multiple properties and you're not self-employed, we don't want to see taxes. We just want the W-2s, and those come from the employer. Jennifer Sabino. Yeah, we're up to 60 viewers in August. That's good. I like it. We're going to get to 100. We're going to get to 100 concurrent viewers. I got good faith in it. Yeah, we forgot to tell people to hit the likes. People should be hitting the likes. That would be very, very nice, and I would much appreciate. They're not going to consider a HELOC for cash reserves for rental, even though I get your point. I get where you're coming from, Jennifer. You're like, I got my HELOC. I can pull 50 grand any day. The answer is no. A lender's not going to consider that as reserves, even though it certainly is, right? I currently use my VA loan 2 times. Will I be able to use FHA at 3.5% for third purchase? You could. My question would be why? Why would you want to use FHA? If you got good credit, you probably want to do a 5% down conventional. It's going to be light years better than FHA. FHA, bless FHA. It's becoming less and less attractive as a mortgage product. It's just as good as conventional's got and as cheap as conventional mortgage insurance has got. Conventional just side by side with FHA just wins 90% of the time. If you're 640 credit score, 620 credit score, 600 credit score, you got to do FHA. Don't have to necessarily at 620 and 640, but it's better. But other than that, conventional is just winning. Uh, 30-year conforming refi at 3.125. Shoot me what you're looking at, Jeff. Matt, M-A-T-T at mattthemortgageguy.com. Did I ever make a banner that was that? Let me see. Matt at mattthemortgageguy.com. If your credit's good, you should be able to get lower than that. It sounds like based on the APR, there's little fees involved, so it's not bad. It's decent, but a broker can probably do better. So, man, I'm going 2 bottles tonight. I'm getting hydrated. So, it's a good loan, but I want to get you a great loan. So shoot me whatever info you can at mattthemortgageguy.com. I'll take a look. No problem, Striker. Happy to help. Happy to help. Jason Hibbert, thanks for joining. I would like to cash out, pay off debt, and buy another property, but I still need to lower my credit utilization, currently at 30%. Well, I mean, I guess the only reason why you care about credit utilization is how much it's affecting your credit score. And so I would start the process of a cash out. And if your credit score comes back at 670, you might be like, man, that sucks. We pay off some cards to get up to 700. Then I'll do the cash out refinance. But if your credit score is 740, 762, then, who cares about the credit utilization? You can start the cash out and start doing, putting together the pieces of your plan. Credit utilization only matters in that it affects your credit score, and it only affects your credit score if other pieces are hurting, right? And I've used this example plenty of times. I think I had 18 credit pulls in a 12-month period, and my credit on my last refinance was still 790. So It's worse than average. It's not ideal to have 18 credit pulls, but I did, and other parts of my credit, like utilization and other things, are really low. So my credit's still great. All right. Me and my husband, we have 2 car payments, and we got pre-approved at $300,000. If we pay off the car payment, are we going to get more? Yes. It's all a function of math, and it's all a function of debt to income ratio. Here's where you want to be careful is if your mortgage payment versus your income hits a certain threshold, then you're not going to get that much more buying power by paying off debt, because a lender is looking at 2 different ratios: your front end ratio, which is your mortgage payment versus your income, and your back end ratio, which is mortgage payment plus total debt versus your income. So let me give you an example. You've got $5,000 in monthly income. Your mortgage payment by itself is $1,986. I used a random odd number like 1986, but we can round it to 2000. That's about 40%. So let's say that you've got a car payment added to that makes your total debt to income, that back end ratio, 44, because you got a $200 payment. So that's $2,200 out of $5,000 income. So now you're at 44%. If you pay off that car, you might not be able to go any higher, because that front end ratio being 39.84, whatever the heck it is, right? 1986 over 5,000. There's no room in that to budge. Hopefully that made sense. We might have to press rewind and go back and say, what's he saying? He's saying that even though I pay off the car, I can't get approved for more because my mortgage payment, my front end ratio is maxed. That's what I was saying. I don't know if that made sense, but hopefully it did. You should, if you got a couple car payments, be able to up what you're pre-approved for by paying off one. So the answer to your question is yes. Kim Kardashian, is Die Hard a Christmas movie? Absolutely. Jeff M., thank you. You're welcome. Dorothy Jones, does FHA have a timeline for refi with the NOD? I don't believe they have a timeline, but like I said earlier, Dorothy, it's all going to depend on your findings from the automated underwriting system. Gets plugged in and it goes ding, 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 and it sees 30 day, 60 day, 90 day. And it's like, warning, warning. I don't know if we should approve this loan. I think you're going to want to have 12 months of payments in, on-time payments for sure. Guess it depends on everything. How late was it? Was it, did you have 6 months of 120s? James Petrie, thanks for joining. If you move an investment loan taken out in your personal name into an LLC, does that trigger a due on sale clause? Some say lenders don't care as long as they get paid, but it sounds scary. Let me tell you something, James. I have personally done that at least 10 times and never had anything come up with due on sale. And I can tell you that of the thousands of loans I've done for investors, and the at least a few hundred times know that they moved it into an LLC, never, ever, 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 ever has a lender called it due. Ever, ever. And I talk to lenders daily. I'm in masterminds with lenders that are doing 2,000 loans per year. Current brokerage I'm at probably averages between 5,500 and 6,000 loans a year. Different nationwide broker organizations I'm part of where there's 20,000 brokers. Never, ever, ever have I heard of a lender triggering the due on sale clause. So if you were the 1 in a million chance that it happened, you would be 1 in a million. All right. Score is currently 700. Was this the San Francisco one? Oh, this is you whether you should lower your debt utilization. I mean, between 700, 720, 740. Here's the problem. Let's say today we're like cash out refinance is 3.25 for your 700 score and whatever, loan to value. I don't know what it is, but let's just throw a number out there. If you said, if I pay off some cards, I do this, I do that, I might be able to get to 725. If we wait 4 weeks, 6 weeks, all those things to be paid off, it just show up on your credit report. And at 720, the rate is higher than it is now at 700. We didn't make up much ground, right? And so I would look at the cash out refinance, see what it looks like. If it makes sense, I would do it now, because today's rate at 700 might well be better than September's rate at 725, if you're picking up what I'm laying down. What's up, Andrew? Not crazy high, but that's pretty high. Part of it, Andrew, is that 20% is a lot worse than 25%. I'll plug that in for you. And you sound like a guy, what'd you say, perfect credit? All right, let's put in 780. That's not even really perfect, right? But that's pretty good. 400, putting down 20%, and investment property. Tell me you're not like in Ohio and buying an $80,000 property, because that always changes. The lower the loan amount, the higher the rate, because it's expensive to do loans. And so lenders have to charge higher rates for these itsy bitsy loans because they're not making any money. $80,000 loan they sell on the secondary market, they make 19 cents. So they got to charge you more for those itsy bitsy ones. Wow. Yeah, 20% down, bro. The pricing is not that good. This rate sheet I'm looking at stops at 3.6, but it's a point in cost. So you got that, which would mean I could probably go like 4 1/8. 4 1/8 is probably no cost. I'm going to pull up another lender here to see what we're working with. Home Point Financial. Man, it's fun just having all these lenders to choose from. Yeah, see, if you put 25% down, you can go like 3.5 with no cost. So like that extra 5%, do it, dude. I ran the numbers with Mike Zuber last week on a podcast that I'm a guest on once a week. One rental at a time. Great guy, great channel. You should check it out. One rental at a time. And the yield at 25% down beats the yield at 20% down, even though you're coming out of pocket more money, because the rate difference is so much, right? 4 1/4 versus 3.5. This person's got 4.6. They're probably 3.75 or 3.875 on a 25% down. You know what? I don't want to log in and do all that stuff. I'm just going to tell you that it's high. It's not crazy high because it's 20% down. But if you can do about 25%, do it. No problem, Jason. Happy to help, brother. Yeah, do conventional. You don't want to pay 1.75% up front. And that's one of the big downsides of FHA. You buy something for $400,000, you're spending $7,000 in upfront mortgage insurance. Gets tacked on the loan. You can't avoid it. 1.75%. And you're paying higher mortgage insurance. If a 780 score, way higher mortgage insurance than you would at 5% down conventional. Side by side, not even freaking close. Conventional's way, way better for your scenario. All right, random animations. What is the process to see a house or have a tour? Is a pre-approval enough to have a tour? Also, what if I don't have 20% down payment? Good news. You don't need 20% down, not even close. Connect with a lender, get pre-approved. You can look at 3% down options, 3.5%, 5%, depending on your credit score, depending on that. But once you're pre-approved, you want to connect with a high quality realtor. That realtor is going to help you with your home search. And now that open houses, I think, are ripping and roaring in most parts of the country, you can go to open houses on your own. You can have the realtor schedule an appointment to see a house that might not be being held open, But get yourself pre-approved. Step 1, connect with a great realtor. Step 2. All right. Good to hear, my man. Finally closing with U Mortgage for your refi this Saturday. Yeah, they're not always easy. Even a team as good as mine, sometimes we run into hiccups, but good to hear that it's closing, man. I like to hear that. And hopefully they took good care of you, knowing that you came from here. If they ever give you any grief, tell them you're going to go rat them out to Matt the mortgage guy. But yeah, that's for anybody wondering. U Mortgage is where you're likely going to end up. You fill out my quick form and you're out of state. They're licensed in most states that I'm not, and so they're going to be able to take good care of you. Al Smith, I appreciate the kind words, my man. I'm not seeing folks who refinance at 3% applying for another refi. I mean, it just doesn't make sense. Refinances cost money. And in order to really have enough value for a refinance to make sense, you're going to want to save, 3/8 minimum, usually 0.5%. And some people might even think that's crazy to talk about 0.5%, but I'm telling you, if you have a $675,000 loan amount and you save 0.5%, you're going to save $3,500 a year in interest, and you're going to spend less than that, on the refinance. You're going to recoup that cost within a year. What I am seeing, Al, some people that had a 3% or a 2.875, they're now looking at it and going, holy moly, I've got all this equity. They're tapping out their equity, and they're not super rate sensitive, where it's like, I know the rates are great, and I know I'm going to pay slightly higher for a cash out refinance. I don't mind that I'm going from 2.8 to 3.1, or I don't mind that I'm going from 3% to 3.15, because I'm pulling out 60,000 in cash and I'm going to do X, Y, and Z. And that's more important than the, 1/8 higher I'm paying in interest rate. So the ones who I am seeing that are doing multiple refinances, either refinanced when it was 3.5 or 3.75, and now they're doing another refinance. If they got a rate that low, like you said, 3%, only reason they're tapping back in is to pull cash out. How many percent closing costs does the buyer pay? It's hard to say it as a percent, because it's really not a percent thing. There's like certain fixed costs where if you buy a $200,000 loan, it might look like closing costs are 3.5%. Buy $1 million home, I had somebody recently tell me like, oh wow, I thought closing costs would be a lot higher, like near 3%. Well, not at this purchase price, because at the $1 million purchase price, the fixed cost of some of the title fees and the fixed cost of other stuff, your total closing cost might be 1.2% or something, right? So it's a hard to really put a percent behind it, and it's really hard to put a number behind it too, because some people are going to consider prepaying property taxes and homeowners insurance as a closing cost. It's not, while it's rolled in and it's actually considered closing cost on your loan estimate, it's a recurring cost. It's not a one-time cost. The one-time costs that are loan costs, lender fee, title fees, appraisal, all that, like that's about 3,000-ish, whether you buy $1 million house or a $200,000 house. If you tie in prepaying property taxes and homeowners insurance and prepaid interest and all that other stuff, then on the lower end, it can be a couple grand. If you're buying a house with $1,350 a month in real estate taxes, then that number might be $9,000, right? It's a long-winded way of saying it varies. I wouldn't say huge. Listings have increased. Not huge though. They're definitely up, like across the country. Not huge. Dorothy, you had 10 years late? That's going to be troublesome. I mean, your credit score has to be a little bit affected by 10 years late. Shoot me a message. I'll do what I can to help, but probably need to get at least 12 months of good of payments under your belt, right? Make some on-time payments for at least a year. Show the lender you've turned a new leaf. I would say escrow accounts are probably 95%. 95% of buyers pay tax and insurance through the mortgage, and then 5% of people choose no escrows. I personally escrow all my mortgages. I just don't want to be responsible for paying all that stuff separately. It's time, effort, and energy I don't really think is necessary. Just let the lender handle all that stuff. If I do a cash out refi, does that reset the 1-year residency requirement? What P. Diddy is referring to here is, you buy a house owner occupied. You're stating that I intend to live here for the next 12 months. And so you're saying, if I do a cash out refi, does that reset it? Essentially it does, right? Like you can't do a cash out refinance as your primary and then 1 month later go, oh, I'm going to buy a new primary. A lender is not going to like that. That is going to be a red flag. That's going to be a big no-no. Sure, things change and happen. And I've had people do a cash out refinance and go, oh, I decided to move, and they sell their house. They're not going to go to federal prison for that. I've had people after 7 months decide that they're going to go buy a new primary. That one's not going to land them in prison either, but don't intentionally commit mortgage fraud by doing a cash out on your primary residence and then turning around and going to buy a new primary. That's a no-no. That's a bad boy. What is average origination charges? Near zero is what you should be looking for. In box A of your loan estimate, your closing disclosure, you're going to find, let's see if I can find loan estimate. Come on. There we go. Box A of the loan estimate is going to be where the origination charges are found. And I will just pull this one up for the people. I whited out the names on purpose because I used this for, oh yeah, let me put it up right here. So this is a refinance. And on the loan estimate, when you get to page 2 and you get to box A right here, these are loan costs, and box A is origination charges. You should not have more than a couple thousand in this box. This first line right here where there's nothing here, there's zero, is percent of loan amount points. So on this loan, this was the rate 2.831 with no points being paid. If there was points being paid, this is exactly where it would show up. It would show up percent of loan amount, 0.5 points, $1,200 or whatever it is. Underwriting fee, flat fee, 1055. Some lenders will have, processing fee, admin fee, $995, $555. You don't want to see a lot of those fees in here. If you do, then you know that you're comparing it to another loan estimate that might have just this flat fee of $1055 and it's worse, right? Because it's got more cost. But in general, for origination charges, depending, if it's an investment property, or you're paying points, or you're doing other things for other reasons, like it's not the worst thing in the world to have a couple $1,000 in origination charges, but this should never be like $9,700. If you get a quote from Quicken, you'll be like, well, gosh, they were offering me a 2.5% interest rate. That's really smoking hot. And then you scroll down, you're like, oh, percent of loan amount, 2.5 points, underwriting fee, stick it to you here fee, this fee. And then there's like $9,500 in points. That's no bueno. A refinance like this where I'm showing it somebody, I'm like, listen, you're saving $200 a month between origination, appraisal, and the title fees, you got $2,800 in cost. This is going to break even in 14 months. If you're going to stay here for more than a few years, this is a good looking loan. That's the kind of stuff you should be looking at. When box A, which is literally the only box that we control as lenders, when this one has a lot of charges in it, run the other way. All right. Property New Jersey, FICO 700, LTV 45%, current interest 4.25, 20-year. Is 75% cash out refi possible on a 15-year? Yes. How fast can a refi be closed? Probably in 22 days. More often than not, the lender is not holding you up. You're holding you up. And I say that with complete love for the people that I work with. We can close loans really, really fast, but some people just aren't ready for fast. We give them 3 things to collect, another month's of bank statements, another pay stub, a letter of explanation. And, when it takes them 9 days to get that stuff back, that's where we run into problems. All right, 75%, 700 credit score, rate and term. Oh, cash out refi. My fault. Cash out, 75%, 15-year. I bet you this is about 2.25, give or take. So for your scenario, that's pretty good. Yeah, 2.375 on a cash out. 2.25 would be about a half a point. So you'd probably, depending on how long you've been in this 20-year. Oh, I guess you're pulling cash out. You're pulling cash out. Never mind. I was going to say your payment's going to not budge much, but you're pulling cash out. But yeah, you're going down to like 2.3, 2.225 to 2.3. Smoking. Fill out that form at greatmortgagebroker.com. They can hook you up. Demetrius, you're missing all the stuff, man. See here? He's telling me 75% LTV. He's telling me 15-year term. He's telling me loan to value. I 817 credit score. It's going to be sub 3%, but depending on how much it's worth, how much you're pulling out, I give you some more detailed information. If the rate lock expires, you don't get the better current rates because current rates are better. You're subject to worst case pricing at most all lenders. The only way to take new interest rate is to wait 30 days after your rate lock has expired. So, yeah, I would not want a rate lock to expire, especially right now. Rates have gotten worse for 4 straight days. See, this is something I don't like. I don't like this, S-Kim, this application fee. Well, 1,000 is fine. Like we looked at, like I don't mind the where'd it go? Oh, I lost it. But I don't mind a 1055 flat fee from a lender. What really irks me is when there's a application fee that gets charged up front. Don't ever do that. It's literally a lender's way of like holding you hostage. You've paid us $1,000. If you leave, that's a sunk cost. Gotcha. That's just not a good practice. The only lenders that do that are the shittiest ones. So please, please, please don't let a lender charge you anything up front. Whoops. Whoopsie daisy. There we go. I wanted to show you guys this. Something we're working on. Create a little roadmap. Initial disclosures, appraisal ordered, submit to underwriting, underwriting approval, appraisal received, resubmit to underwriting, clear to close, doc signing, and funding. I think I'm going to make a video on this after we jump off here. It's going to be live tomorrow. But this is going to be a little walk down the path of buying a house and what you should expect. I'm going to make the video, and what I want you to do is watch it tomorrow, 2 p.m. Pacific Standard Time, give me some feedback. Say, Matt, that was great, but I'd like you to add this or that, because it's still a work in progress before we actually release it to the masses, to all our clients. So I appreciate everybody that joined. Get in your questions. This is last call for any mortgage questions. Happy to help. Trying to get these things down to an hour and a half. There's so many questions to ask, and there's so much fun to be had. I appreciate each and every one of you that joined. It really is fun jumping on here every Monday. You never know what to expect. I've got a couple questions. One about dividend income from my buddy Warren Druin. One from Onel Act about modifying and then refinancing. So we'll see what answers I get in regards to those, because those are questions that I admitted, hey, listen, I'm not sure. Let me find out. And then we will reconvene next Monday at 6 p.m. Pacific Standard Time. Thank you for joining. I appreciate you. Bless you as well. Thanks for everyone that joined. Really was my pleasure getting on here. I learned something. Hopefully you guys learned something. If there's anything you want to see, jump onto YouTube, shoot me a comment, join us live on Mondays, shoot me a message. If you're in California, happy to help. Matt at mattthemortgageguy.com. If you are outside of California, then we've got greatmortgagebroker.com. Fill out that quick form. You'll be taken care of, just like my buddy Caden was from U Mortgage, or somebody who's licensed in that state. So far, I'm just California. Who knows what 2022 and 2023 bring, but for now, I'm serving as many people as I can in California. Outside of California, you got to fill out this link, get connected with a trusted partner. Thanks for watching. Appreciate you guys. Till next Monday.